master the power of three. So I'm actually going to keep this PowerPoint very, very simple, as I believe this concept is actually very simple and it's just overcomplicated. So my promise by the end of the video is you should know how to implement the power of three into your trading from weekly all the way down to the individual sessions, being London and New York. So these are the 5 areas I'm going to target. First, we're obviously going to look at what is power of three. Then we're going to go into the weekly candle and its pathway. Then we're going to dissect the daily candle in both London and New York. And at the end, I have some sort of fair value integration, which is a little bit of a, not pattern, but a methodology that you can use today to actually implement the power of three very effectively and finding very high probable setups inside of price. So what is power of three? So power of three is basically the idea that a bullish candle will first open, let's say at the low. It will then travel downwards, creating a low in price, and then pushing higher, creating the high in price, and then tailing off, creating an upper wick and creating or closing here, right? Vice versa, this is the bearish candle. I've put this as black as my candlestick colors are green and black. We'll open up. We first will then travel higher, okay, creating the high, then traveling lower, creating the low, and then closing off somewhere above the lowest point in price, right? This is often referred to as open low high close, or OLHC. This is referred to as the opposite, OHLC. Okay, now why is this concept even relevant? Why are we even talking about this idea? Well, if we know, okay, for example, on a weekly candle or a daily candle that we are anticipating, let's say a bullish candle, then we can expect a run against us first and then an extension towards the target that we're looking for, right? And this move against us is typically referred to as the Judas swing, which is basically a false move on price, okay? And vice versa for the bearish candle. So this is actually majorly overlooked. This is an extract from ICT. This is part of, I can't remember the exact area. It's probably the 2016 mentorship, 8 or 9, okay? But this in itself is a daily cycle or a daily profile that he taught, right, that I use fairly often inside of my trading, right? So this is breaking down the expansion of a bearish candle, right? So this, number one, is we have the opening price, and price actually runs against us, okay, running higher, right? That's sort of like the first stage of the candle, okay? Then the second stage would be price is running lower during London open. So the high is essentially created up here. We've had then a London swing to the downside, okay, all the way down to, let's say, this low here. And then during pre-New York, we tail off that move ever so slightly with a retracement. Then stage 3 would be New York open, actually extending all the way down, creating the low or potential low of the candle. Then during London close, okay, it's likely that New York may not create the low, and actually London close will extend lower, creating the full low of the candle, and then tailing off again, closing somewhere above this low, right? So either New York open will create the low or London close, okay? And in this drawing, they've also mentioned the 5-day ADR as well, which is the 5-day average daily range. All that is taking the last 5 days of price and averaging them, and then creating or finding that average, so then you can forecast the expansion of the current let's say daily candle in this example. So let's have a look at the weekly candles pathway. Right now I have 3 different profiles. I have mentioned this before, but I have 3 different sort of profiles, cycles that I like to see play out in price, right? You have the classic expansion, you have the midweek reversal, and you have consolidation reversal. So classic expansion is basically when we create the low of the candle on Monday or Tuesday. We then see price expand midweek and then tail off either Thursday or Friday. Midweek reversal is when we travel towards a PD rate or consolidate on the first 2 days, Wednesday tapping that higher time frame PD array, creating low of week, and Thursday and Friday expanding. And then consolidation reversal. This one doesn't really happen that often. Okay, these two happen, I'd say, majority of the time, 85% of the time. This one doesn't really play out that much. So you could, if you really wanted to, just X this one off and only focus on these two. But for argument's sake, we have consolidation reversal, which is basically when we consolidate for the first 3 days of the session, we tap a higher time frame PD array on Thursday, and then we expand on the last 2 days of the week. Okay, so how do we actually use this in each profile? Well, this is where the weekly open comes in. Okay, so understand the weekly candle actually starts here. Okay, so what are we actually trying to do here? Well, let's say you've already got the daily bias, right? So let's say you've done all that inner work, you've done all the back end stuff, and now you're just waiting to see the week play out. Okay, so you have the weekly open set as a price that is very easy to find. We draw that open and we extend it out across in price, and then as price travels beneath the weekly open, all of that is essentially considered as a discount, right? Any area beneath the weekly open would be considered a good buying price. Now, does that mean we will just simply buy underneath the weekly open? If you was a swing trader, you could actually go about doing that. Okay, I personally wouldn't. I'd be looking for the lower time frame details, things like market structure shifts, CSDs, potentially on like the 4 hour, the 1 hour, to actually frame my idea. But if you actually wanted to, anything beneath that weekly open is something where you can look for buys to essentially hold inside this weekly range, and then you can end up TPing later on during the week. So for example, let's just say it looked like this, right? Or we'll do two scenarios. We have the first scenario where, let's say Monday was a consolidation and Tuesday actually wicked out Monday's low and we had some displacement. You then may look to take a trade, and that might be around the weekly open. So now you've entered a trade, right? And Tuesday has created the low of the week. So now what do? We have a think, okay, cool. What sort of cycle does this look like it's playing out as? Right? It's this cycle here in front of us. So then what we do is we plan the day that we're going to end up taking profit. Okay, so for me as an intraday trader, I'd probably look to take off majority on a Tuesday, as I don't really tend to hold through the week. But if you was a one shot one kill type trader, the guys who like to hold throughout the week, maybe with a larger stop entering beneath, let's say Monday's low as a total soup or something like that, then we'd look for price to extend all the way till Thursday, and you'd actually look to take profit in and around New York Open on Thursday, which is basically ICT's guideline. Now that's one way of doing it. The other way of doing it is that we have a higher time frame PD array. So let's say you're targeting a daily FVG, and Tuesday doesn't reach it, Wednesday doesn't reach it, even Thursday doesn't reach it, right? So you may just be looking for this higher time frame array for price to get hit. You may notice that Tuesday, Wednesday, or Thursday don't actually reach that target, and therefore Friday ends up pushing and extending into that target, and that's where you take profit. Okay, so there's multiple ways to actually go around doing this, but what we understand here is because we're seeing this weekly profile play out, that when we draw out this weekly open, we can look to buy underneath that weekly open as a discount, right? And now, of course, I've showed you a lot of different scenarios. I wouldn't know personally how you trade, so I'm trying to tailor it to multiple trading styles. I actually missed something out. So the second point I missed was, let's say you didn't want to try and enter beneath the weekly open. Okay, the next best thing, or I'd say it's actually better to do than trying to enter beneath the weekly open, is we create the low. So we set the low in on a Tuesday, for example. Now we extend. Now Wednesday has opened itself up to be a very, very, very high probability buying day. So what you can do is for example, let's say here potential immediate rebalance, for example, maybe there's an FVG in there, and then you'll look to apply what I'm going to talk about in London and New York to actually frame yourself inside this Wednesday candle to then capture. Let's just say that this also has a economic calendar release on it. You're going to be able to encapsulate majority of the weekly range inside this Wednesday's candle. So you sort of have two ideas. You either enter beneath the weekly open, maybe with a bit of a wider stop, or you can really allow price to just start moving inside your direction. We actually close above the weekly open, and then Wednesday, Thursday, the consecutive days are actually a lot more high probability. We have the second profile. So this one would be where, for example, we hang around, okay, Monday, Tuesday, we go and reach the PD rate on Wednesday, and then we extend higher. Now, again, two ways to look at this. We can either look for or look to be sort of that turtle soup trader lower down in the leg. Maybe you want to enter beneath Tuesday's low with a wider stop, for example, or you can wait for Thursday to travel above the weekly open after manipulating on Wednesday, and then enter in and around Thursday. Maybe London pushes higher, New York retraces, and again you'll see the profile that I talk about on the daily in a second. But maybe you'll look to trade a NY continuation, and the same goes for Friday. Okay, as long as we haven't hit a target, that would be my advice. As long as we haven't actually reached a target here, then you should be okay. Otherwise, you most likely Friday may not really extend too far. And then finally, we have the consolidation reversal cycle, where Thursday creates low of the week and Thursday and Friday expand. Again here, let's say we have the higher time frame PDRA here, liquidity built up Monday, Tuesday, Wednesday. You can be a buyer underneath here as a turtle soup trader, or you can wait for movement above the weekly open. Again, you can really experiment with this and pick how you want to go about doing this. Maybe you want to see a closure on the daily. Maybe you want to see displacement in a session. It's totally up to you, personal preference. Looking at this picture, potentially we have a London continuation, and then actually using that cycle that I showed you, the ICT extract. Let's say we had a London expansion, pre-New York retraces, New York continuation, okay, on Thursday, and then maybe Thursday you just want the turtle soup to play out, and then we'd have a CSD, and then Friday you see the followed expansion higher, and then potentially Friday is your better day. Now, I've showed you 3 different cycles. A potential question that may have come to your mind is, how do you actually know which cycle is going to play and which day is likely to create low or high of the week? And this is where the economic calendar comes in. Okay, so I'm going to give you an example of one profile. When you see FOMC or major news releases like CPI, and how you can actually go about using this news release. So in this specific week, right, we'll just look from Monday to Friday. So Monday had no news. We'll just look at USD news. I know there's GBP here, but we'll ignore that. So no news, Monday and Tuesday, right? And then Wednesday hits and we have FOMC rates, or FOMC statements, federal funds rate. And it's very, very likely on FOMC weeks that Monday and Tuesday are not really going to go anywhere, or more or less just be liquidity generating events. And if you actually go ahead and look into this week, right, so this is 2024, the week of June, Monday the 10th to June 14th on a Friday. Actually go ahead and look what day created the low of the week in this cycle, which days had very nice expansions to the upside. What you'll end up noticing is that Monday and Tuesday actually ran above. So we were anticipating a bullish week, right? And this is on DXY, by the way. And we wanted to see the week expand to the upside potentially, right? And what actually happened was on Monday and Tuesday, we actually ran higher. And even for me, this ended up throwing me off. But what actually ended up happening was then FOMC went against us. That's where the low of the week actually formed. This was the Judas swing. So this ended up forming low of the week. And then Thursday and Friday ended up extending price higher. And this ended up being a midweek reversal cycle. But like I said, it's very, very statistically in your favor that Wednesday, especially on that FOMC week, plus the fact that we have CPI, that you're going to end up forming the low of week on days like this. So this is how we'd use the economic calendar. And again, obviously FOMC is every 6 weeks. I'm pretty sure it's not going to be around all the time. But then what you can do is you can look at other weeks. You can document how other weeks form based on their economic calendar releases. Like you could do this for NFP, right? And you could have a look how much of an influence Friday's price action has on the rest of the week. So daily candle pathway in London. Now this is a visual depiction of the classic expansion. This is the ICT depiction that just drawn up. The cycle itself is Asia consolidation. London runs beneath Asia or above for a bearish example. We then have a London expansion. We then have a retracement. And then New York looks to continue the move of London. And then London close ends off the high, creating high of day. Now this cycle is really overlooked. Like ICT drops these cycles throughout his mentorship, but I think this is really overlooked. I have talked about in previous videos about profiling the daily, and this is how you actually do it, and this is how I personally do it. I have multiple cycles. This is one cycle. This is again the classic expansion. Price doesn't always follow this cycle, and I think that's where the idea where everyone's sort of looking for a fit, right? Everyone's looking for some cycle that plays out every day, right? But that isn't really going to happen. The market is very dynamic, and we look for different cycles, right, that play out throughout price. That's sort of the key here. You need to view different profiles. You need to actually build a collection of profiles, and the only way you're actually going to be able to do that is analyze price day to day. So let's actually have a look into London. So here we have two different pathways in London. These are you could say the most popular. Here is basically what is referred to as a London protraction. This is referred to as a delayed protraction. London protraction being where price consolidates during Asia, actually runs beneath Asia, and then extends during London. The other one where Asia consolidates, we actually tap, let's say, the midline of Asia and then run higher. Now, in my personal opinion, this cycle on the right is very low probable. There is a cycle where Asia does create low of day and it is high probability, but again, I'll leave that for another time. But on the left here, we see price run beneath the daily open and then extend higher. Okay, so anything beneath the daily open is offered as a discount. Okay, so what you want to do is in this specific day, let's say for example we're in a midweek reversal cycle. Let's say Wednesday is created low of week, and we're now on Thursday where we're anticipating a expansion to the upside. We'd want to then look for the idea of a power of 3 on the daily candle, which would mean we would want to see some sort of Asia consolidation and then price run beneath that level, looking for a potential buy in the form of a turtle soup or a change in state of delivery or market structure shift, however you want to go about tackling that. Now, a little key tip. This move typically will run till about 10 to 12, and if you are going to get in this on an intraday perspective, I would try and TP some of your trade in London, because as you'll see in the next slide when I talk about New York often leads to an OTE retracement of London. So let's say London expands higher. What will likely happen, or what you actually want to see this in New York, you want to see price retrace in between that sort of off zone between London and New York, and then you want to see price come and potentially actually tap the daily open again, right? If you extend the daily open price, you'll see price ends up reacting around this level quite a lot. But what you'd want to see is ideally is some sort of OTE retracement of London. So let's say London's low to London's high, or just above London's high. Let's say the high of that extension was made an hour after London. You'd want to see price retrace back into that 62 to 79 level, ideally just underneath the equilibrium pretty much. Okay, and then you'd want to see New York expand higher. Okay, and again, just a little key tip: if you draw out 8:20 Eastern Standard Time, that can actually become your new daily open price for New York as a sort of a filter. So here what we have is Asia, London expand, pre-New York retracement, and then New York opens and we run to the upside, right? And you'll notice here like I said, typically the daily open will get tagged again, right? And maybe you'll look to long underneath the daily open. Again, it depends how you want to go about this. Typically, there'll be an FVG here. You can either enter off the FVG with stop beneath London low, or you can wait for a change of state delivery. This will more or less be on the 15-minute, 5-minute, or a market structure shift. However you go about entering, or you want to be the propulsion block person or the second stage accumulation. It's totally up to you how you want to go about entering inside of there. But this pathway or this cycle is super high probability, and you can look for this in price. Like if you actually go into your own charts and you have a look at this cycle, you'll notice this cycle plays out a ton. Okay, now typically, right, New York is a continuation of London, right? But sometimes you're going to get New York actually reverse, right? And this is actually referred to as a New York reversal cycle. Okay, and in this example, anything above the daily open would be seen as a premium. Now, how do we distinguish between the two? This is where the daily bias comes in, right? In my personal opinion, you shouldn't really be guessing whether New York is going to expand or reverse. Okay, your daily bias should have already done that heavy lifting for you. Okay, so in this cycle on the left here, right, we're anticipating a bullish day. Okay, we're actually anticipating the daily candle to first retrace against us and then expand higher, and then retrace a bit and extend higher again. Okay, however, in this cycle that I've drawn here, your daily bias would actually have been bearish initially. So for example, so let's just say it's the classic weekly expansion where Monday, Tuesday makes high of the week, and let's say we're now on a Wednesday, for example, where we want to see a bearish day play out. We know the high of the week's being made, prices above the weekly open, and we want to see price drop a bit lower. Then Asia opens up, right? But instead of running above Asia, London actually runs beneath Asia and runs against us. Okay, now this shouldn't waver or scare you out of your bias because you already are bearish, right? So if London ends up playing against you, you just know that you're going to wait for New York to essentially open up, sweep out London's high, and then you can watch New York reverse against you. Okay, well, not against you, but in the direction in which you anticipated the daily to actually expand to. So you shouldn't really ever be, and I have been there before, but you shouldn't really ever be in a position where you don't really have the daily bias. You see London play out, and then you're like trying to work out where New York's going to go, whether it's going to continue or reverse. You should already know which way the daily's going to expand to, and then if London expands against you, you can just look for New York to extend in the original direction in which you anticipated price to go. And like I said, anything above the daily open is a premium. I haven't actually mentioned what time the daily open is. I've assumed that most people know that, but that is midnight New York if you're unsure. It's basically just the end of Asia, but I'm sure most people will know that. So lastly, the fair value integration. Now these I'm going to give two different profiles that you can actually go away and use in your trading tomorrow or today. So the first one is the idea, and what you should do is you should actually work this into your weekly and daily profiles, and you'll end up finding really high probability setups just using this alone. So let's say we're in a buy program, we're bullish. We have this blue area, which is a bullish FVG. Price trades down into it. The following candle actually fills the candle completely and closes bullish, right? And the drawn liquidity is up here. What you'd want to do is you'd anticipate the next candle after that to actually extend and hit the draw there, right? Like this. The reason you'd anticipate that is because the FVG has been fully filled. So price has no business trading lower. We've actually traded away from an FVG and filled one. And price is in that buy program, so you're anticipating price to go and reach for liquidity above price. So how can you actually implement this with everything that I've just taught? Well, think about it in terms of the weekly cycle first. Let's say this is Monday. Let's say this is Tuesday. So you're anticipating the week to be bullish. Let's say, for example, this FEG was the higher time frame PD array. Let's just say this is on the daily time frame. So this is Monday, this is Tuesday. Now that you've seen Tuesday create the low of the week, filling an FEG, you can now confidently anticipate Wednesday to be a high probability expansion to the upside, and then you can go in on the lower time frame and look at, for example, London expanding in your favor and then potentially New York expanding in your favor. So you have two trade opportunities there, or London may trade against you and then New York may be the trade that goes and takes out the liquidity. Now the second one is when the FEG doesn't get filled, and because the FEG doesn't get filled, you need to be a bit more careful with potentially seeing price trade lower and against you, wanting to fill the FEG, right? So in this example, this same background is there. We're in a buy program. Let's say we're seeking liquidity above price, and this is again the daily time frame, and this again we're looking at Monday and Tuesday here, a weekly profile. So we tap 50% of the FEG. Let's say this is Monday, let's say this is Tuesday, and we're looking for the following day to extend. The only additional thing that I'd add, because we haven't filled the FEG, is a change in state of delivery. So let's say this is on the daily, I'd look for the change in state of delivery on the 4-hour or the hourly time frame. And a change in state of delivery looks pretty much where we're in a sell program on the intraday time frames, and then we notice a closure above, let's say, the last set of consecutive down candles in price, which would flip the idea that we're in a sell program to a buy program. And that's basically what a change in state of delivery actually is, or what it acts as. So once we get that on the intraday time frames, then you can look for again the following day to extend higher, looking maybe from this FEG, for example, to retrace in and then extend to take out liquidity. Okay, so that's pretty much the entirety of this video. Like I said, I wanted to keep this video very, very simple. I feel like this term can be thrown around a lot and really overcomplicated, but this, in my opinion, is the bare bones of it. Like I said, it's very simple. You're going to look at weekly expansions, daily expansions, economic calendar, and then you can add in the fair value integration as well if you like to create a model. You could literally create a model out of everything that I've just mentioned inside this video. So anyways, hope you guys enjoyed the video, and I'll catch you guys in the next one.